Hey guys, Florida Real Estate Sales Associate course, Chapter 18. Taxes affecting real estate. Taxes are, tax rates are charged in mills, which equals to 0.001%. Well, 0.001. To convert mills expressed as a whole number into a decimal, the decimal place is moved 3 spaces to the left. For example, 6 mills, 0.006. 3 space, to the left. I don't know if that's the left for you guys, but okay. Each taxing authority first establishes a budget forecasting the amount of revenue needed to fund operations for the coming year. Money that is expected from all sources other than real estate taxes is estimated. Property tax assessments. The estimate of value that is determined by the county property appraiser is called the assessed value, which by law must be based on the concept of just value. Protesting a tax assessment is a 3-step process. Protest the assessment by requesting an informal conference with the county property appraiser. Homestead tax exemption. The basic $25,000 exemption applies up to the first $50,000 of assessed value. To qualify for the homestead tax exemption, one must own the property and be a resident of the state on or before January 1st and must file for the exemption with the county property appraiser between January 1st and March 1st of each year. The property must be the owner's primary residence. Veterans of military service with at least a 10% military service related disability is eligible for a tax discount of $5,000. Any quadriplegic is 100% exempt from payment of real estate taxes. Any paraplegic, hemiplegic, or other totally and permanently disabled person who must use a wheelchair or is blind is 100% exempt from payment of real estate taxes. Save Our Homes Act. Beginning with the calendar year of 1995, the assessed value of homestead property is limited to the amount of increase the county property appraiser may assign to the lesser of 3% or percentage change in the consumer price index (CPI). When homestead property is sold, this limitation will be removed and the new owner will be assessed at the full taxable value. Exempt property. Property owned by churches and nonprofit organizations engaged in charitable activities are assessed for tax purposes but receive a 100% exemption from payment of property taxes. Immune property. Property owned by local, state, and federal governments are immune and not assessed or subject to taxation when used to provide government services. Government-owned properties that are leased to private businesses such as office buildings and warehouses are subject to real estate taxes. Calculating a real estate tax levy. First, calculate what taxes would be without any exemptions. Next, calculate both exemption tiers, $25,000 basic and the additional $25,000. Special assessments. Special assessments are tax levies. I'm not sure how you say it. It's tax levies or tax levies. Any lawyers in the house? Special assessments, or anyone who speaks English properly. Special assessments are tax levies to pay for specific public improvements that add value to the property. Special assessment liens may be for paving the street, connecting property to central water sewer system, street lighting, and so on. Delinquent property taxes. If the property owner does not pay the property taxes before April 1st of the year following the assessment, the taxes become delinquent. Tax laws affecting homeowners that file itemized returns. Real estate property tax deduction. Real estate property taxes are deductible as an expense when calculating federal income taxes for all homeowners who file itemized returns. Mortgage interest deduction. For tax years beginning after 1987, taxpayers can deduct mortgage interest paid for acquiring, constructing, or substantially improving a principal or secondary residence on up to $1 million of acquisition indebtedness. Acquisition indebtedness is defined as a mortgage debt incurred to acquire, construct, or substantially improve a principal or secondary residence. Home equity interest deduction. Taxpayers can deduct interest paid on up to $100,000 of home equity indebtedness in addition to interest paid on acquisition indebtedness. Sale of a principal resident. The Taxpayer Relief Act of 1997 established new tax treatment for homeowners when the sale of a principal resident occurred subsequent to May 6, 1997. Under the 1997 Tax Act, married couples who have owned and used a property as a principal resident for at least 2 of the previous 5 years to sale may exclude up to $500,000 of gain on the sale from taxation. Wow, that's a lot. Okay. I think that's it for chapter 18. Yep, we're done. Oh, there was one math thing that, it's how, note that each owner is only charged for 1/2 of the cost. It's basically how to figure out, for improvements, special assessments, when the government pays for like some of the improvement, because it's going to improve like the property. It's how to figure out the city share and the each owner share. So let's say if it's a street with 8 residents on it and it's $100,000, the improvement would be $100,000, and the city agreed to pay 50% of it. So $50,000 divided by 8, which is how many people it's going to be affecting. It's very simple. That's all. Chapter 18, we're done.